we are rather conscious on the outlook of the Chinese economy because economic indicators such as fixed asset investment and retail sales show clear signs of deceleration in terms of growth rate. For instance, the fixed asset investment of China only grew by 5.5% in the first 7 months this year, which is even lower than the GDP growth in the first half. And retail sales used to grow at double digit, about 10%, but lately the retail sales only grew by around 9%. And also leading indicators such as the Purchasing Managers Index, the Caixin market, China PMI in particular, shows signs that the Chinese economy will decelerate further. And together with the US trade war, which is deepening, will cause economic growth to slow further in China. The performance of the Chinese stock market and Hong Kong market deviate from the US market. I think the main reason is the US economy is still very strong, especially on the labor market. Non-farm payrolls every month and also the initial jobless claims reported by the US shows that the US labor market is still very strong. And this will help consumer spending and also lend support to corporate earnings growth. But for China, as I mentioned earlier, that the economic growth is slowing down, so that will cause corporate earnings to slow down as well. So stock market tends to run ahead of the economy. So the drop in the stock market is actually a reflection of expectation of lower corporate earnings going forward. Let's look at the definition of a bear market. What's a bear market? By defining bear market, there are two criteria which are commonly used. First one is share price or index drop by 20% from the peak. And second one is the indicator of moving average. If the index or share price drops below the long-term moving average, for instance, the 200-day or 250-day moving average, then it's defined as entering a bear market. So looking at these two criteria, the Chinese stock market and Hong Kong market are actually in a bear market. For the Hong Kong stock market, average time span for a bear market is from 12 months to 18 months. And now the Hong Kong stock market actually enters the bear market when it peaked in January this year. So this bear market has already continued for 9 months. So if we look at the long-term average, that means the bear market of Hong Kong stock market has already passed half or 1/3 of its life cycle. So my advice is we have to be patient for the ending of the bear market, and once the bear market hits the bottom, we will be entering another phase of bull market. One distinctive features of the bear market is the market tends to drop most of the time, and any rebound will be rather short-lived. And the magnitude of the drop always exceeds the magnitude of the rebound. So for investors who look for short-term trading opportunities, they have to be very agile and they have to be flexible. And for investors to make profits in bear markets, they may consider using some shorting strategies. For instance, shorting on stocks or using derivatives like put warrants to make profits from price declines. And thirdly, for long-term investors, actually a bear market is not necessarily a bad thing, because it provides opportunity for long-term investors to invest in stocks that have good potentials at a lower price. So one may adopt the strategy of accumulation, to accumulate shares as the share price continues to fall. And provided they have the holding patience and holding power, once the bear market ends, they'll see the payoff from their investment.